Welcome back to the channel, everyone. Manny B Investing in BI, and we're going to take a look at a June 28th blog from Paribus. How does finance work? Understanding why we want to build a new future of finance is key. In this article, we cover TradFi structures, what to be aware of in DeFi, and how Paribus is building for a better tomorrow. Let's take a look at the blog posting. How does finance work? Interesting. The recent upheavals within the DeFi and wider cryptocurrency space has left many commentators declaring that crypto is dead. The reality, however, is that some platforms, chains, and investor groups have fallen foul of market shifts that expose their weaknesses. DeFi and crypto are far from dead, and this article will help to explain why. One of the strengths of the cryptocurrency lacking regulation is that there's no safety net for the people investing their time and resources in the space. In more regulated spaces, when banks fail, their depositors are covered by government insurance. Lacking a bailout mechanism means that platforms and protocols have to provide genuine purpose, otherwise they risk absolute failure. Taking borrowing and lending as one example, we've seen this happen when companies use their clients' funds as if they were their own to engage in high-risk trading. And we talked about this on the last blog post. This is known as rehypothecation. Taking funds that have been provided as collateral by clients to then use them as collateral on further trades. In the US, this is regulated by the Securities and Exchange Commission, or SEC, which stipulates that banks must have the client's permission before they can use their collateral in this way. In the last bull market, there was a huge pressure for hedge funds and platforms to provide high yields to their clients. If the clients could easily get 30-50% gains just by holding altcoins, why would they lend their crypto for 5%? As such, many players in the markets offered unrealistic yields of 20 to 50%, which could only be delivered by using rehypothecation. It may sound strange, but in traditional finance or TradFi, banks don't need people to deposit money in order to create loans. When they issue a loan, they simultaneously create the money required for the loan as a deposit credit on their balance sheet. The only requirement is that they have to ensure they have sufficient liquidity in the event of a bank run, so they don't have to pause withdrawals. Whereas stablecoin issuers such as Tether will most likely be required to have 100% reserves in the forthcoming regulations for the space. Banks don't. In the US, they only require 4% of reserves in readily available liquid assets, which they can borrow from other banks at a very low rate of around 1%. In TradFi settings, banks can create as much money as they want to lend and pocket the difference between the interest they pay on having to borrow 4% of the total loan versus the interest charged on the 100% of the loan they give. For instance, a $100,000 loan, which they charge 4% per year, may only cost them 1% interest per year on a $4,000 loan from another bank to back their reserve requirements. In simple terms, the customer would pay $4,000 interest per year for the loan, and the bank would only have to pay $40 in interest per year to create the loan. In reality, TradFi is far more complex than the above example, but it demonstrates the underlying principles of modern-day fractional reserve banking. Legacy financial institutions can make huge profits without having to take excess risk due to the structure of the systems they work within. DeFi, on the other hand, has to rely upon transparency and clear information to gain people's trust to make further unrealistic claims and face the inevitable subsequent failures. Another word is the banks are protected by this big scheme that's supported by the governments, and crypto is not. Crypto is you got to show or prove. If you don't, then you may not get the faith of the person providing the liquidity. So it's a harder game. It's a very hard game. So that's why you have to stay on your toes and understand there's no underlying systems that are going to save a Coinbase other than their reputation. So believing in your head that Coinbase will never fail and that your money is always safe might be a silly idea, but a lot of people think that way because they have an unrealistic expectation of what and how Coinbase actually operates. So be careful with your crypto, not your keys. not your crypto. The way in which Paribus works is similar to the principles of traditional old school banking. It acts as an automated financial intermediary connecting pools of lenders with pools of borrowers in a permissionless, trustless way. The way the platform makes money is through transaction fees and arbitrages between the yield paid to the lender into the pools and the interest charged to borrowers from the pool. From time to time, platforms may boost the yield offered to lenders into pools as an incentive to help build the total value locked, or TVL. However, if a platform offers a larger yield to its lenders than its interest charged to its borrowers as a standard practice, alarm bells should start ringing, like Olympus, and they were giving out thousands of %, and people were like, oh, this is a great deal, we should do it. And I said, this doesn't make any sense. Why would you do that? This extra money has to come from somewhere, and it's most likely coming from user clients' funds to take out leveraged trades or deposit in other protocols. As we examined in a previous article, we will never engage in rehypothecation. Anytime we offer incentivized yields, there will be strictly time limited and pre-funded. That's important. You want stuff pre-funded. You don't want to rely on Peter to pay Paul from a program standpoint. That would be terrible and set you up for failure, such as like all of these protocols that have failed their users and stolen their money. We believe strongly that borrowing and lending platforms have a key part to play in DeFi, which is why our approach is focused on long-term stability, not quick, easy money. One key to understand the importance of borrowing and lending platforms in the future of cryptocurrency is understanding supply and demand, low risk yields, and taxable events. Risks, as always, priced into markets. So when the yield is high, either demand is strong and supply is weak, or there's high risk. Our yields and interest rates are dynamically set so that they fluctuate based on supply and demand, not risk. If you're offered a permanent 20% yield, there's bound to be some significant behind-the-scenes risks that isn't being disclosed. Instead, we offer a logical, low-risk, transparent system. Understanding taxable events also helps to explain why there's a need for platforms such as Paribus. If you use your crypto as collateral for a loan, you can use those funds tax-free in any jurisdiction throughout the world. Many tax laws treat your collateral as unrealized gains, and you only become liable to taxation when you sell them. Aside from taxation, many people who hold large bags of crypto don't want to sell them, especially in a bear market. Using them as collateral enables holders to finance the ventures without having to lose any of their tokens. When it comes to NFTs, the wish to hold onto the asset and release some of its liquidity is even more imperative. Despite the turmoil we're seeing at the moment, it's important to understand that this is simply a bear market getting rid of weak or bad protocols and platforms. In this respect, the present conditions help the market act like a self-cleaning oven, which is why building during these times is the very best thing any project can do. So they're continuing to build, and other projects are popping up, looking to develop to roll into the next bull market, if we are so lucky to see that in the near future. Thank you again for checking out the content. Make sure you hit that like, hit that share, and subscribe. We're going to continue bringing you Paribus news updates. We're going to be expanding into DeFi and learning protocols. So be on the lookout for those videos. We'll see you again on the next one. Peace.